Hello everyone, welcome to Money Matters. I am Prayag Agarwal, a student of Finacle Institute, Surat. Today with me, I have my batchmates, Jaivansh Mehta and Shrod Gupta. Today we are going to talk about learnings and teachings of two of great investors of our country, Mr. Rajashekhar Iyer and Mr.Chaytania Dalmia. We are going to look through their investing journey in this video. So without a further delay, let's learn. Rajashekhar Iyer was from Tamil Nadu, came to Mumbai in 1980s, a chartered accountant by qualification. He has over 30 years of experience in the field of equity research. He came to Mumbai with adequate capital. He wanted to start something of his own. In 1990, he set up Securities Investment Management Private Limited, his research advisory service. With all these, he also started a weekly newsletter called The Value Investor. He loves to buy a company with great profitability, which is available at cheap valuations. Let's move further. In early stage of investing, he bought stocks, relied on other advices to decide which shares to sell, which shares to buy, but soon realized it was not working very well. He started analyzing companies as by reading annual reports. Initial success boosted his confidence. He also had a successful trade in MRF by selling their shares. Later, he became a financial journalist and editor, analyzing company annual reports and writing critical articles. This experience laid a solid foundation for his career in investment during a significant run in the bull market. He later then went on to start his own research firm by quitting his job as an editor, and they started publishing a weekly newsletter called The Value Investor, where they used to recommend stock on weekly basis. Let's move further. What was the basis of buying and selling shares at that time? When asked in the beginning, he relied on reading annual reports to make investment decisions, focusing on profitability ratios and balance sheet ratios. In the growth indicators, he preferred low price to earning stocks, but missed out on high quality, high growth stocks like Infosys. Then he explored technical analysis, but could not find a reliable method. However, reading Benjamin Graham books such as Security Analysis and The Intelligent Investors provided them with a solid framework for value investing. With their financial statement analysis skill, they began valuing companies based on simple techniques and were attracted to undervalued stocks. When asked about 1992 market peak and subsequent fall, he said, in 1992 in his newsletter, they used to give a stock of the week. The recommendations were generally good. Of course, the market was high because of crazy valuations. The index doubled for next 2 months and the market crashed in April because of the security scam exposed in 1992. The market crashed from 4500 Sensex to 2700 Sensex. 1988 to 1992 was the first bull market of Mr. Rajashekhar's year life. He witnessed index going up to 11 times in 4 years. In this period, he made money because the value approach made him took profits. Asked about his investment philosophy, he said, in the second bull market of 1990s, he realized the importance of optimizing selling prices and staying invested longer to capture larger profits. However, he faced challenges due to lack of macroeconomic understanding and focused only on individual company analysis. The impact of inflation, monetary policy, and economic growth in stock valuations became apparent in 1995, when smaller companies were significantly affected. The distractions of their research business and inadequate risk management further contributed to their poor performance. These experiences led him to recognize the need for more comprehensive investment philosophy that includes macroeconomic factors, fund flow impact, and sound risk management. Moving on, when asked about the bull market of 1998 to 2000, he said, recognizing the significance of technology's boom, they invested in IT stocks. Mr. Iyer knew that the stocks were overvalued, so in 2000, after the price surged, rather than holding it for long, he sold it. Despite not selling at the peak, they still managed to retain a significant portion of their gains. They primarily held Hindustan Unilever as a buy and hold stock, driven by their belief in its growth potential tied to the domestic economy. Moving on, himself HUL. In 1993, he invested in a company called Photophone, which went up 10 times from the price while discussing with an investor friend They discussed about how investors should always be willing to risk a portion of his profit. He should protect the most of it. So he sold HUL when the 30% of the profits were gone. The main learning was that the shares can't trade below or above their fair trade value, which went up 10 times from the price. While discussing with an investor friend, they discussed about how investors should always be willing to risk a portion of his profit. He should protect the most of it. So he sold HUL when the 30% of the profits were gone. The main learning was that the shares can't trade below or above their fair trade value. Changes in investment ideology. In the period of 2003, after Mr. Ayer's portfolio was in cash, he had no stocks and was waiting for a new bull market and was focused only in trading in the market. He started to figuring out which stocks to buy, hold, quantify risk, and how to set stop loss. The concept of stop loss would be explained by my batchmate, Jayvansh Mehta, later in this video. Two things were of concern for him. First, how to call the beginning and end of a bull market, and position sizing. If he had more allocation in his best ideas, it would be a lot more profitable trade. After reading a lot, he realized that to quantify risk management and limiting losses, which could be achieved by better trading position and stop losses. 15 years later, he felt that he had a proper knowledge of market and now he was waiting for 2003 to 2008 bull run. Let's talk on case studies. Caterpillar Inc. was global leader of earth moving equipment. The stock was trading below 20 rupees. It was very cheap. During the meeting with a team of Caterpillar, they told how they were competing with Kirloskar Cummins, having 95% of the market share, while Caterpillar had good research and development team of $2 billion. He thought that it will do well against Kirloskar Cummins, and the economy was also recovering. The stock was so cheap, it did well and went up 6 times. That was the first time he bought 25,000 shares and did a good job on that trade. Photophone was another Indian brand which used to sell photographic films by importing film rolls from Japan, cutting them into pieces. The stock was very cheap, the earnings were growing. According to the new rule of election committee of having an ID card with photo as the member of voters were huge in this country, so the sales went skyrocket. The stock of 17 turned into 165. Mr. Ayer's first 10 bagger. That time, he was short-term investor but decided to hold on to the stock. But the company was turning obsolete. Unfortunately, it all came down at 17 again. It was not a good success, but was a great learning. He was aware that buying was his strong point, but only had problem with selling. In his one of his big success was Divi's Lab. In 1990, after being ignorant to the company's promoter, he missed the opportunity to buy Dr. Reddy's Lab, which again went up to 85 times the price. Divi's Lab IPO happened in 2003. It took time for Divi's Lab to settle. It valued at 4 times less the earning growth. Profitability looked good. The future could be growth could. One of his success was Divi Labs. After missing the opportunity to buy Dr. Reddy's Lab, he was now ready to buy Divi's Lab as they were into pharmaceutical outsourcing business. Their IPO came in 2003. It valued 4 times less the earning growth. Profitability looked good, and future growth could be 10 times of the price. Challenge was position sizing and risk management. After listing at 180, he bought at 200, some and bought some at 225 and then at 275. While he kept stop loss at 200, slowly the stop loss turned into 590 and his stop loss never got triggered. On Mr. Ayer's friend recommendation, he analyzed Nagarjuna Construction and all other construction companies, with Nagarjuna having the best capital efficiency and hence the best return ratios. Its ROE was 21%, having market cap of 35 crore and the book order was of 650 crore. So he did a comparative analysis of all the construction companies. It was a well-run company with huge tailwinds because of NHAI projects. What if there is a sharp correction in stop loss and our stop loss getting triggered? Step up investing cannot be applied to every investment. It can happen if you anticipate large upside or you have to put a stop loss at the level that it will only reach the company has some major change in their fundamentals. Step up approach allows one to put a large portion while managing the risk of capital loss. There is no other reason for the stock to fall below purchase price without any major change in the company. The strategy is not to overpay for stocks. You might end up paying it. In that case, stop loss can be very useful, which would be explained by my batchmate, Jaivansh Mehta. He built a large position by pyramiding, then he meaningfully invested in one stock and turned out to be a very good stock for next 10 years. He had a good functional research on a company. When you have multi-baggers like this, it's there is a major difference between allocating 25% of your funds on your best ideas or allocating only 5% of your funds. Have you been holding it ever since you have position is? Yes, he's holding it. He sold it twice. First time when it was trading 35 times earning at 2000, he took his profit before it came down to 1600 and bought it again 1200 to restore his position. So you didn't buy the whole position at the base price but averaged up. Information is never perfect in the market. So when you decide to buy, have detailed research. He will not add up to his position while declining prices, but will add up to his position only on increasing prices. If the stock is cheap, company is growing, it will grow, but we don't know how it will play out. We have to play our probabilities. The next topic of stop loss would be explained further by my batchmate Jaivansh Mehta. Information is never perfect in the market, so when you decide to buy, have detailed research. He will not add up to his position while declining prices, but
Hello everyone. Now I would like to explain you the concept of stop loss. Now stop loss helps you avoid the losses which you would have otherwise had to bear. So for the ease of your understanding, we have taken the help of some numbers, and which is explained by Mr. Rajashekhar here. He said if his portfolio composition is 10 lakh rupees, then and for example he can afford to lose 10,000 rupees. Now that is 1% of his total portfolio. And for example, if he decides to lose only and he has an appetite to lose only 35 rupees on one share, and the current market price is for 440 rupees, then he will put his stop loss at 405. Yes, that is 35 rupees. So by dividing 10,000 by 35, you will get the number of shares that he has to purchase. Now the amount that he has to pay to purchase the share is 1,25,714. Now let's say if the stop loss gets hit, so the amount that it will be amount of 125 will be reduced to 115. So his loss is limited to only 1%, which would otherwise have been much more if he had not put the stop loss on 405. In the next scenario, he says that if he has a risk appetite to lose 90 rupees on a per share, then he puts his stop loss on 350. So by dividing 10,000 by 90, he gets the number of shares, that is 111. So the total amount that he has to pay for purchase the share is 48,889 rupees. And for let's say if the stop loss gets triggered, then the amount will be reduced to 38,889 again, which is only a loss of 1% of his total portfolio. Now how this helps in investing? In investing, you there are very much risk of the prices going down rapidly. So in order for you to hedge yourself from those downfalls, you can put stop losses. Now let's move on to our next topic, which is technical analysis. Mr. Rajashekhar here believes that technical analysis only is used as a like complementary to the financial analysis, because he doesn't like to look only at charts, because there are some other important aspects to look at as well. He says if you have a long-term business view, then you can take a look at charts, and if you have like continuous funds to deploy in the market, then it's good to use technical analysis. He says he does not like. He also takes into account the price risk, because he does not want to lose his money. Like for example, he gives an example of Infosys, which was trading at 14,000 in 2003. Now, surprisingly, in only in the next year, the stock came down to 2,200. So this was a price risk. Price risk. So he didn't wanted this to happen with other investments. So he also uses technical analysis to avoid that price risk. Now with technical analysis, there is also a concept of free shares. Now what is the concept of free of cost shares? So sometimes what happens is, for example, if we invest 50,000 in a we invest 50,000 in the market, and due to some reason the investment value turns into 1 lakh. So now what most of the people does is they sell their capital, they sell 50,000 worth of shares, and they think that they withdraw their capital, and now what they have is the free of cost shares. But this is a very wrong ideology, and I'll explain you why. Now if your investment has doubled, right, from 50,000 to 1 lakh, now why would you can exit from the company? Wouldn't you have like to ride the trend of the company and make more investment, or rather at least maintain your that is generating position? He was asked how does he generate investment, because the price increase doesn't mean you have to withdraw your amount. Reads like right? Many annual reports of companies, like he reads about 100 companies, and he says if you read 100 companies you might be able to find 2 or 3 good companies, and even in that 2 or 3 companies you have to do further analysis to check whether this company is worth investing or not. So let's take an example here. He has said that he had found a company known as Garware Polyester. This company had an EBITDA of rupees 90 crores. Now let me first explain you what is EBITDA. EBITDA is the earning before interest, tax, depreciation and amortization. Basically it is the earning of a company before non-cash expenditures and the payment to income tax and the debt holders. So it had a EBITDA of 90 crores and a market cap of 200 crores. A market cap of 200 crores means the company was worth 200 crores at that time. But one problem for that company was it had too much borrowing and interest cost, which was a very big red flag for Mr. Iyer. So then he found another company which was known as Polyplex Corporation. Now the wonder with Polyplex Corporation is the company started with mere 1500 tons of capacity, and it had went up to that capacity had went up to 18,000 tons of capacity over 10 years. Isn't that marvelous? And the one more surprising fact about the company is that it did expansion without dilution of equity. Now there are only a handful of companies that can do without dilution of that can do expansion without dilution of equity, which is what it remarks as the one of the very few companies with brilliant management. Now let's move on to our next topic, which is the rejection point of a company. So the first rejection point of a company, according to Mr. Rajashekhar here, is lack of scalability. Now, what do you mean by lack of scalability? The lack of scalability means that if the company has only a narrow market to capture, then it cannot grow in the future. And the second is poor quality of management. No matter how good the product of the company is or how good the company is earning right now, but if it has a poor quality of management, then those poor decision making power of management will ruin the company's earnings as well as future potential. Talking about future potential, if the company has a very low future potential and it is into making something which is only has a short term demand like mask, then we cannot project company's future earning because it has a very low future potential. And the fourth point is valuation could be a very important criteria for rejecting a company. Reason being, the company can be extremely overvalued, ruin the company's earnings as well as future potential. Talking about future potential, if the company has a very low future potential and it is into making something which is only has a short term demand like mask, then we cannot project company's future earning because it has a very low future potential. And the fourth meant it has good long term potential, but if it is overvalued right now, there is no sense of investing in that company right now. So talking about rejection point, there are some errors that we make while investing in a company. There are two types of error explained by Mr. Rajashekhar here. There is type A error and type B error. Type A error refers to the wrong decision making. So what is wrong decision making? Like we invested in a company which was not, we didn't fit according to your checklist, but you still invested in it anyway. So it is okay. You can recover those losses. Type B error is a major error. Type B error refers to the loss of opportunities by investing in a company with expensive valuation purely out of FOMO. Now, what is FOMO? FOMO means fear of missing out. Just because everyone is investing in that company, you are trying to ride those trend, but you didn't actually understand that company was overvalued, and just because of the optimism from the market, it is earning that much valuation, but it does not deserve those valuation. Okay, now let's move on to our next topic. He was asked, what do you do when you raise cash and the market's incorrect? So he says that it is very important that we do our market analysis very thoroughly, and it to hold cash till you get an instinct of upcoming bull market. It is also important to establish a downtrend and not to exit early and maximize profit. So sometimes what happens is if we hold cash for a long time and we don't see markets correcting, we get that instinct to invest immediately and not to miss out on the trend, but he refuses to do that, and he asks the investors to wait for a bull market, and he also asks them to wait for a downtrend and to not to exit early so you can maximize your profit. Then he was asked, how do you know it is an established downtrend or it's just a dip? He says that when a company is earning 30 to 35% growth, he is earning 30 to 35%. Sorry, he is earning very well and he's growing at 30 to 35%, and the stocks corrects a little bit, then it's okay. It happens. It's the nature of the market. But if the earnings falls then this is supported by the fall in the market price, then there's a red flag that he gets alerted by about the condition of the company. He said that it's significantly over he said that sometimes a company gets significantly overvalued and it starts falling. So he said you should immediately get into cash and not hear about everyone else and think that everyone is not selling and only I am selling. You should not worry about that and start looking for new ideas to invest so as to maximize your profit. Okay, the next one he talks about the companies where he got the best opportunities. The first one is a 3M India. 3M India is a company which was an opportunity that he got once in his lifetime. Because after 2008 crisis, the company was available at a market cap of mere 10,000 crores. And what's surprising is this company had a sales turnover of 1,000 crores. So he bought this company when it was trading at 2 to 2.5 times of sales. He said that this type of offers don't really rarely come, and if you get one, you should immediately invest in it because it's kind of a no-brainer. And the second company is Automotive Excel. He had bought Automotive Excel after 2008, but in 2000 after 2008, the commercial vehicle segment had collapsed, and there was a downtrend in the sector, and companies was not able to earn profits, and their turnovers were dropping, their market cap was dropping. But he knew that this type of companies can earn profit due to their growth in the economy. So he stayed invested in that company when that company was trading at a market cap of 200 crores. When that company was trading at a market cap of 200 crores. Now he talks about the investing in companies where the earnings growth is strong but the valuations are high. The first point he says is that there are only two ways to earn in a company, and that are earnings and valuation re-rating. So what do you mean earnings? We already know what do you mean by earnings, but what do you mean by valuation re-rating? Valuation re-rating means that company is getting valued more and more only because of the optimism from the market, which is not actually sustainable in the long term. So we should be aware about that. And the second thing he says that if we buy an expensive stock, then there is no possibility of valuation re-rating because maybe it is already priced in. And the third thing he says is we should not always just keep sitting on the companies which have already been successful or which have already shown growth. We should always be looking for next big opportunities. Fourth thing he says is that he thinks position sizing is more important, and it is more difficult to get the correct position sizing, and it is more difficult than finding the right stocks. He said it is better to make 10 to 20 times returns in 5 to 10 years instead of just 3 to 4 times return. And the last thing he says that she does not believe in investing in safe or mediocre companies just to be defensive. Now let's talk about his portfolio composition. Now, historically, he says only 5 to 6%, 5 to 6 stocks accounted for two-thirds of his portfolio. Another 5 to 6 made 15% of the portfolio, and the balance of 20 to 15% of the portfolio will be in 10 to 12 stocks, which were either getting sold or bought. And his portfolio turnover was very low for a long time. Portfolio turnover means trading, buying and selling of stocks on a regular intervals. Next topic is risk management. He said he had a very bad risk management strategies before, and he failed before, so he started learning about risk management. So he said about a book written by Mark Douglas, Trading in the Zone. He said that book helped him learn more about position sizing, and he increased his ability to trade. What they basically taught him was, if he had a risk appetite of losing 20 lakhs in an investment, then if he only invests 20 lakhs, then he has a risk of losing 100% of his capital. But wait, if he invests 2 crores in a company and put his stop loss at 20 lakhs, then he is possibility of losing is only 20 lakhs, but his upside is infinite, right? So he learned this from reading the book Trading in the Zone. Now let's talk about his investment process. The first point is that he likes to be creative and he likes to keep finding better ideas, and he also likes to reflect upon his past investment decision so as to not repeat those mistakes again. And the second point is he found that the companies which are earning potential in the future have a very big chance of success rather than the company who are just undervalued, and which are in turn better than the company who are waiting for a turnaround, because turnaround may or may not happen, and it can so happen that your wealth might get destructed due to waiting for the turnaround to happen. And the third point, he says that he only likes to invest in a stock which has a good history, and he likes to only look at history of the stock rather than waiting for the stock to turn around, or maybe he does not like to project future about the stock, and he only likes to invest based on the history of the stock. And the fourth point, he says that investing has three parts: deciding what you want to buy, at what price you want to buy, and how much you want to buy. And he says that he values a company where the growth of the business is meaningful in the future, and it also majorly depends on the attractiveness of management in its decision making ability. He says that he values the company based on its current state. The valuation takes into the current assets, the company's liquidity, current earnings, cash flow, etc. And the next point, he says that he decides how much capital to allocate. Now this point basically depends on how much value you think the company deserves. Then that according to that you can allocate your capital towards the company. And the last point, he says that he values the company based on its current state, which includes the current earnings, cash flow, etc. And the last point, he says that if all the above factors are present and they are not already priced in by the market, priced in means the price of the current price of the stock is reflecting all those positive aspects, then he will buy the company because the company has a upside potential. Now he explains his investment process to taking an example of Nava Bharat Ventures. Now this company was making only 15 crores of profit with a market cap of 35 crores in 2003. Now after 1996 to 1997, the company was was in the business of converting ore into alloys. Now in after 1996 to 1997, the ferro alloy was in a bad phase due to weak commodity prices. Now, due to these factors, companies in the industry were either defaulting on the loans, getting debt restructured, and one of the companies also got debt restructuring of 1,800 crores. But surprisingly enough, Nava Bharat Venture was the only company who not only paid principal and interest but also paid dividend to the shareholders. Now let's dive deep into how they did it. So the business was into converting ore into alloys. So they didn't actually own ore mines, but manufacturing alloys require ore and power. As they didn't have control over the price of the ore, they thought of establishing a power plant. So that actually turned to be very profitable for the business. How the cost of power per unit of manufacturing required was 6 to 7 rupees per unit. But for Nava Bharat Ventures, as they established their own as their own power plant, they had to only pay 2 rupees per. They had to raise only 2 rupees per unit, which proved to be a very big major cost advantage for the firm. Now this resembles how important is the management decision making in the down cycle, because it is very crucial. It can have impact on the firm in the long run. Now let's talk about the topic: how do you value a company? The three important variables to value a company is how much they grow their sales. Second is how much profit they make from that sales, and what kind of capital do they need to generate that sales. And one more important point is how much cash they are generating from that profit. He has taken the example of DMart to explain this concept. He says that if the company is earning 1,000 crores of profit, it will have 15,000 crores of value if it grows at the rate of fixed deposit. Now this growth is called the steady state value. What is steady state value? If the company grows at the rate of fixed deposit, then what value it will have? For a company like DMart, it will have 15,000 crores of value if it grows at the rate of fixed deposit. And the further any valuation above that 15,000 will be called as growth component, and it will be called as growth component of the value, and it will be based on the growth aspect of the company, how much percentage growth is company earning every single year. And if I see that when the major contribution is done by the steady state value, then we can call the company overvalued. Now why would you call a company undervalued, sorry, why would you call a company undervalued if the major contribution is from the steady state value? Reason being, if it's only growing at rate of fixed deposit and it's earning this much amount of value, then what if the company starts growing at higher value, at higher valuation? It will earn more valuation. So he says that he does not like to project more than 3 years of cash flow for a particular company. Now,
So hello, I would take you to from your to the further topic. So the interviewer asked Mr. Rajashekhar Iyer about the past investments and how many stocks in how many stocks he had made big money. So sir explained that with a very little portfolio, he has made returns in with very little stocks in the portfolio, he had made maximum returns. So if we consider 2004 to 2005, he had made a 70% portfolio gain from only 2 to 3 stocks. And the second thing, the major winners in the portfolio came from when he bought undervalued stocks. So when he bought undervalued stocks, the upside of the stocks were uh, the upside but the upside for the stocks were pretty high. So there he made very high returns there. And the third point is he he said that lost money in smaller positions when he bought stocks without analyzing it. So let's move to the second topic, the important good stock. The first point is strong earnings growth after you buy it. So after buying a stock, there's a strong earning growth for a company. The second point is low P turning into a high P after buying it. And the third point is the stock starts moving fairly quickly after you buy it. The third point is an important point because you buy before the market participants, and when the market values that stock, the prices of that stock would keep increasing, and you have bought it before the market participants. So your returns would be more than other people. So let's move on to the next topic. How do you manage risk at the portfolio level? So the first point he says that he looks on a 1 year timeline, and he looks for some favorable and unfavorable circumstances in the market. So if there's some unfavorable circumstances, he would go through his portfolio and look for which of the stocks are getting affected because of the unfavorable portfolio and which is causing the drawdown to its portfolio. So he would manage his risk there. The second point here is he has given a drawdown for two factors, like a stock specific drawdown and a global market drawdown. So he says that in stock specific drawdown, you should keep a stop loss and maintain the losses there, and the stop loss concept was previously explained, so he follows the same concept here. And the second is overall market decline. If there's an overall market decline, he says that convert your portfolio into cash and wait for the market to settle. So these are two of the drawdowns he has talked about. The third, he's explained an example of the company Titan, which he says that in 2005 to 2006, the valuation was quite expensive. But after the Lehman Brothers crisis in 2008, the valuation of the stock came down and it was available at a cheap price. But the margins of the company were 100%. He explains the next point here he explains are is two different factors: fundamental deteriorating and a stock a stock you like, but you ignore the like many points. Two of the factors here he explains is fundamental deteriorating and a stock which you like, but you ignore the bad performance of the quarter. So your portfolio can see a drawdown. And he also points out to a fact that if a stock is not performing or it is flat, like it is not declining or it is not seeing an upside, so that could also be a problematic situation to your portfolio. The next thing he points out to is seeing the downside of the stock. And if you buy a stock at an expensive valuation, so what is the if you buy at an expensive valuation, what is the downside risk to that stock? So these are the risks that he sees at a portfolio level. So next, the interviewer asked Mr. Rajashekhar Iyer about investing in commodity and cyclical stock. So Sir says that the cyclical industries are mainly driven by the volatility of the commodity prices, which is at the underlying. So here it is the ability of the company to effectively manage the cyclicality. And here he says that he sees the assets that is worth and the capacity that a company could produce and manage these cycles. So one of the key thing of his investing is seeing a cyclical business and investing in those companies who he sees the earnings could come when there's an upside of that cycle. So he buys that company whose earnings can be seen in emerging. So his view on cyclical stocks are these. So let's see about the second question. The year sir talks about leverage. So he says that it is okay to take leverage, but only in exceptional circumstances and only if you see a short-term return coming. So only that time you can take leverage. The second question is, do small portfolio investor need leverage to grow? So your so says that it is important for small portfolio investors to only manage risk and avoid the leverage to grow. His views on futures and options is he has not used he does not do futures and options because he's lost money, but he says that if anyone is doing futures and options, his fundamental base should be very strong. Let's move on to the next. So let's talk about the next slide. So yours, the interviewer asked about the year 2000 when Sir was getting his portfolio into cash and he had a view about the market that it had topped and it was too expensive. So Sir said that he had a bearish view about the market and he had sold most of his portfolio. And the same thing he did for 2008. He had maximum of his portfolio. He had maximum of his portfolio into cash, and he had a passive view about the market. His portfolio proportion of cash had increased, and the equity portfolio size had decreased. The next interview about the reading habits about Sir. So Sir said that it is important that you read daily or again and again about some interesting subject, and he said that if some if you are reading something and you don't understand today, it would be beneficial for the future. So it's important you develop a habit of reading and you keep learning. So next question is, sir, the interview asked about shorting in a stock. So sir had an early experience of sir didn't have a pleasant experience of shorting in Colgate. So sir said that he so let's move to the next slide about the macro view Sir has. View of macros Sir had. So Sir is not mainly inclined towards the top-down approach. He says that if a business is having a very high valuation, it should be justified by the financial performance it has. And he also says that the percentage of savings in the household should increase, and that saving should be invested in the coming years. But this should be done by seeing the historical financial performance of the market. So when the interview asked about the personal life of Sir explained that most of his portfolio is in cash and sometimes. So let's come to the next slide. So the interview asked Sir about the personal life. So explains here that most of his portfolio is into equity and sometimes he holds cash from time to time. He said that he had bad experience in private venture and real estate, so he avoids going in that sector. So talking about his day-to-day life, he says that he has divided his stocks into three parts: top 70%, 20%, and last balance 10%. For the top 70%, he views regularly the company's earnings, the valuation. And if talking about the other interest, he reads a lot of book. He targets 2 books per week. He goes on trek, golf, and movies. He has 3 clear priorities. First is health, second is knowledge, and third is maintaining financial position. Let's move to the next slide. His advice to new investors. He says that don't rely on others' thinking. Instead, have your own thinking and develop a habit of reading. Figure out what will make you money. Listen to views of others. Have a reasoning of investing. Increase your earnings so that you could invest more in the market and have a consistent learning and practice habit. Let's see the next one. How to grow from couple of lakhs to 50 crore. So here, sir explains that find big opportunities and manage falls. The second one is you should invest every amount you invested in the market responsibility, whether it is 5 crore or 5 lakh. Invest every amount responsibly. The third point is manage the downfall, because if there is a 50% downfall in a portfolio, it would require 100% of the return to cover that losses. So it is important that you manage the downfall in the stock. The fourth one is develop a skill of knowing the trends of a bear market and a bull market. So it is important to know the trends. Important to know the trends and invest in markets. So from would be introduced, which would. Arey yaar. Now moving to second investor, Mr. Chaytanya Dalmia, which would be introduced by my batchmate Prayag Agrawal.
So let's talk about our second investor, Mr. Chaitanya Dalmia. Mr. Chaitanya Dalmia is a Delhi-based investor with a various educational background. Starting his career in 1998 with OCL India Limited, he has been managing the family office since 2000. His current role as CIO of Renaissance Group involves overseeing aspects such as macroeconomic analysis, corporate finance, legal and taxation, equity investing, structured debt, and asset allocation, etc. With a shift away from traditional fixed deposit investments, he and his brother ventured into another venues, initially seeking guidance from a professional who later left. Consequently, he took on the responsibility of investing in public market, while his brother focused on private equity and buyout deals. When asked about the early experience in the market, he said, during the dot-com boom in 1999, they began investing. The subsequent crash and bear market tested their patience. However, it also presented opportunities to invest in undervalued companies, included undervalued stocks like Tata, Birla, Larsen and Toubro, and Nicholas Parima. They also considered cheap PSU companies such as LIC Housing Finance, BHEL, GAIL, SBI, Bank of Baroda, VSNL, and Shipping Corporation. Notably, their Notably, his portfolio lacked exposure to private banks, IRL, ITC, IT, FMCG, and pharma sectors due to factors like high valuation or perceived lack of expertise. Our investment approach was centered around value investing despite the dominance of growth investing in the history of scams in the Indian stock market. Centered around value investing despite the dominance of growth investing in the history of scams in the Indian stock market. Moving on, when talked about his first major success, he said, during a period of market downturn, he found numerous undervalued stocks in various sectors. Except for technology and FMCG, the investment strategy involved creating a portfolio of cheap stocks with long-term growth potential, supported by discount to book values and attractive dividend yields. He focused on thorough reading of annual reports, buying at low prices, and displaying the courage to invest when others were hesitant. He began selling stocks gradually in 2003-2004 as the market started to rise. Without knowing that it would become a prolonged bull run, the decision to sell was based on taking profit after a period of exhaustion. Moving ahead, let's see some case studies. Unitech was a good company with good financials, had good market access. Sectors were expected to grow and also had macro tailwinds. The best thing was it was undervalued and he was ready to take risk as he already got successful in his previous ideas. The problem was that they had to increase their price by 30% to get the quantity they desired, and some other risks were business risk and the promoter risk. But they made the right call and the stock performed well. It reached 500 times in 4 years. They still held on to some shares, but today the share is just 7 times their original price and down by 95% from its peak 500 times of price due to some circumstances. Despite initial doubts, he invested in LIC Housing Finance, which doubled in value over 2 years. They gradually sold a portion of their holdings as the stock continued to appreciate. Eventually, the stock multiplies 35 times from its original price. The author still holds minuscule quantity to this day. So let's talk about Blue Dart Express. He started getting interested in logistical space, where he found the company Blue Dart. He saw potential scope in the logistical space. He had built a portfolio, and in that one, the stock was Blue Dart. He kept the company even when it was very expensive. He still holds the company shares even it is very expensive, but has made 10 times the returns of original price. This turned out to be buy and hold for him unconsciously. Moving on, let's talk about their few big recent success. During the 2009 to 2016 period, some large cap stocks were available at cheaper prices compared to previous years, but he did not consider them cheap enough due to benchmarking from the previous bear market. Instead, he invested in another bottoms up idea that worked out better, such as Ambika Cotton, KNR Construction, JK Lakshmi Cement, and NBCC. These were well-run business, even after being illiquid, preferring to invest in undervalued stocks. Ambika Cotton, in particular, stood out as niche player in textiles with low-cost operations and premium pricing for their high-value products. Mr. Dalmia shared their experience with three specific stocks: Ambika Cotton, JK Lakshmi Cement, and KNR Construction. The Ambika Cotton was mentioned in the previous. The Ambika Cotton was mentioned. Let's discuss his major miss. He discussed several missed investment opportunities and the lesson learned from them. He mentioned three stocks recommended by a professional, which is HUL, Infosys, and G Entertainment. Despite the professional advice, the stock performed poorly, leading to valuable lesson on risk of concentration and paying high price for quality. He also shared experience with SSI, MTNL, and NIIT Technologies. SSI appeared to be a no-brainer due to cash position. The cash evaporated, resulting in a significant loss. MTNL debt accumulation and changing dynamics caused loss as well. And IT technology seemed like a safe investment with a high dividend yield. The stock significantly appreciated after they sold it. The investor acknowledged the occasion heartburn of missing out on further gains, but highlights the importance of risk management. He also mentioned selling of Nicholas Piramal early, which later saw significant appreciation due to unexpected events. Despite selling early in this case, he managed to outperform by diversifying and taking cash calls at appropriate times. When asked, does dichotomy affect your portfolio? He said, it is much easier to hold overvalued stocks rather than to buy them. One of the reasons for him to hold these stocks is he is trying to check if it is justified to hold secular business irrespective of this valuation. Through this, he has failed in the past for him. He also said that he wouldn't buy the stocks if someone would convince him to buy them today. His ideal approach in investing in a company is finding company that can be double or triple their earnings in 4 or 5 years, and their price to earning would subsequently be related to from 5 times to original price to 10 times from original price. His approach is better than investing a 35 times of price to earning, he assumed, and growing at 12 to 13%, where you are only dependent on price to earning growth of 50 times. He also invests in companies where they have organic growth of 20 to 25 times and are available at 25 times of the price. But having the knowledge to judge these, because he avoids investing in it. When asked the examples of dichotomy, he said the market leaders like Reliance, Airtel, and just hasn't done good in past 7 years. But companies that compounded their earnings for a long time and created serious wealth are HDFC Bank, Asian Paints, Godrej, Marico, Dabur, Pidilite, and Imami. Anomalies were that it hardly compounded, but the payouts were high. Were HUL, Z, GSK Farm, Castrol, Gillette, and Blue Dart. The next topic would be explained by my batchmate, Jaivansh Mehta.
Mindlessly. He says the 15% return is not bad for a year. He says he does not step out in the market to hunt for multi-baggers because he says that he does not like hunting for multi-baggers as already the herd is following that trend and he likes to focus more on the secular growth of a company. He said by using this strategy he has found many good businesses that have compounded his capital very well without dilution at a healthy rate, and the balance and the financial statement have kept the pace with the growth, and the stock prices have also kept the pace with the growth of the company. He says this list includes some FMCG, two-wheeler, housing finances, and private sector banks. He said this company grew well and gave good returns because they have good fundamentals which help them to get more valuations. He says that he sticks to buying cheap stocks and sell them if he sees that they are achieving their peak valuation, or they are becoming more of a weightage in their portfolio. So now let's move on to our next slide. He was asked about how he generate his investment ideas. He says that he and his team does not really have pressure of earning returns, not they have to show their performance to anyone as they are the family office. He says that he would rather prefer to sit on cash rather than just mindlessly investing. He says that he follows the Warren Buffett approach of waiting for the fat pitch in the game where the number of the strikes are unlimited. He says that nowadays people don't really use screens to find the low P earnings company or low price to book value earning company or dividend yield. And he says that these are obsolete way of finding of a company, and he uses this way still to have an advantage over others, and he finds good company using this method. He says that apart from all this, he also takes a look at M&A, buybacks, and merger and etc. to get more information about the current market condition. Now he was asked about how many companies does he actively track today. He says that currently he has 70 to 80 companies of database, and he tracks 32 and other 20 to 25 to 30 financial companies database ready with him, and this list only contains only few indexes and large caps. He says he add companies to his list only after they pass the checklist that he has made about the business, which contains specific points like the honesty and the integrity of the management towards the shareholders and etc. He said that sometimes it happens so that even the good companies are not able to pass through that list and are not able to make it to the list. He says that he mostly relies on secondary data instead of meeting the management in person. He said that the interviewer asked him how can one evaluate such opportunities where the current numbers don't reflect the future potential of a business in advance. So he says that he's a value investor and doesn't like to use spreadsheets or forecasting for a company, and he likes J curves when investing in a company, which shows a rapid growth in the value of the business within a shorter period, which is also known as the hockey stick projection. He says that he doesn't believe forecasting future potential of a company because he can go wrong, and if he does go wrong, he might lose all his capital. So he would rather invest in a better opportunity at a cheaper price. And he says that he does not like to invest based on optimistic model, as he would have to pay the price if he goes wrong, as I explained earlier. And he said he would rather invest in a opportunity where he would lose very small as compared to investing in a company based on optimistic models. Now he was asked about the structure of his portfolio, so he said that he does not invest in a company without the knowledge of the company, and he said that sometimes it takes stocks to longer time to generate return, but he thinks that although they are value investors, the stock should not take a long time to give returns, as he also wants to keep making returns. He says that he has only 15 to 20 stocks, and the weight of the each stock varies from 2 to 3% to 8 to 9% mostly. He says they have preference that a particular stock should not be more than 15% of their portfolio, and a particular sector should not be greater than 30% of their overall portfolio. He says that in his experience, he has learned that he should be aware of the price that he pays for a stock and the weightage that he gives to a particular stock. He says now he's asked about the criteria for disinvestment. Disinvestment means selling of a company. He said that he starts selling company when it approaches its fair value in a bear market, and he buys the company when it approaches its fair value in a bull market, and they keep selling that company in small amounts to gain from that trend of the company. He says that another time they start selling is when the stock become the weightage of the stocks in the portfolio increases due to either increase in the value of the investment or any other reason. But he will start selling that stock regardless of the fact that whether he has found another opportunity to invest in or not. He is okay with sitting on cash. He said that he gives an example of his past investments like BSNL, IOB, or Unitech, which he sold at a perfect time using his strategy of divestment. Now he says that every stock has a cycle just like a business. So for what happens is first the stock is undiscovered by the market, its potential is undiscovered by the market. Then when the stock is discovered by the market, it is very late and all the factors are already priced in the much, and the profit which you are looking to make has already been made, and now you cannot make any further profits. Now let's talk about his approach to investing in commodity or cyclical stock. And this is a very important topic. He says that in cyclical stock, when the capacity utilization is very low, the fixed and the finance cost affect the margins very much, and when the cycle is in upturn, then it increases the bottom line crazily. He gives an example of FMCG company where he says that in FMCG company the annual price increase rate is almost 5 to 6% in the market, but while the same is not well, it is not same with the commodity prices. Because commodity prices are very volatile, and if they go up, they can go crazy up, and if they go down, they can go crazy down. So they are very volatile. He says that although being volatile and capital intensive, you can make good amount of money if you have perfect strategy to invest in this kind of stocks. He says that they have bottom up approach in investing in this sort of sectors and stock. He said that in the sectors like commodity, textile, etc. He has some criteria for investing in sectors which are, first one is they are in business for a decade, that is more than 10 years, and they are not going to get closed in near future. He say, and the second one, he said that they should have a good balance sheet, and that balance sheet should not be beyond repair. Now what do you mean by beyond repair? Beyond repair means they are currently facing a downturn, or maybe there is something wrong with the company, but it can be fixed and it is not beyond repair. And third one is that they are making money even in bad times, like the company. There are some companies, even though they are in bad times, due to their management excellence or whatever the reason may be, they are earning good money even in the downturn. And the last one is that most importantly, the valuation should not be reflecting the future potential of the company currently, because if that is the case, then even if the company turns the down cycle into upside, if that cycle changes, all then also we would not be able to make returns that we would have otherwise expected from the company. He said that he has divided the cyclical stocks into three periods, with a period of 2005, which is the first period, 2006 to 2010, which is the second period, and 2011 to 16, which is the third period. Now let's understand each of this period in much more details. He says that the first period was impacted by the overcapacity, fractured balance sheet. Now, what is mean by overcapacity? Overcapacity means everyone is producing more than the demand. Fractured balance sheet means, as I mentioned, the balance sheet is currently struggling. Fragmented industry, all the players are struggling to make profit. There is a very slow economic growth. They are not able to make profit. The margins are very low. But the second period is of consolidation. Consolidation means that it's a little bit correction in the market, and suddenly there is an increase in the capacity utilization. There is a growth in the economy. Margins are going through the roof. I mean, they are earning absurd margins. Then a lot of expansion takes place at the height of the cycle, and this happens with every cyclical or commodity stock, and cement was no exception to it. The third period came with the CCI slapping fines on the companies. Now, why? Because the company, there was a fuller utilization of the capacity. Companies were more charging more than they should be, and so due to this, the CCI was finding slap on these companies to reduce their prices, and as a result, that resulted in the slow economic growth, poor capacity utilization. And in this phase, some non-serious players who are not actually in the business of cement or any other cyclical stocks were also entering into the industry and to increase their capacity utilization, and to utilize the waste from their other projects. What he found strange was that the capacity could be set up for 400 crore per million ton, which is the average of 10 years from March 2000 in the nominal rupees. But what was strange was the M&A transaction were taking place at 750 crore per million metric ton, or if you want that number in USD, then it was 120 US dollars for per metric ton. Now that uh, the capacity could be set up for 400 to 9 crore depending on the geographical location. But it is very strange that the M&A transaction were taking place at such higher valuations. He says that banks supported this cement project, and they were giving loans very easily to the new players and the existing players for the expansion. He says that during the boom phase, that is the 2008 phase, the capacity increased to 95%, capacity increased to 95% mainly due to the increase in the GDP growth by 15 to 20% due to economic boom, and the volume growth was almost 10% per annum, and the prices were almost doubled in 4 to 5 years. But some of it was because of the input prices, because of the increase in the realization, which was not actually a permanent thing. Now here there is a new concept called EBITDA per metric ton. Now, as I explained earlier, what do you mean by EBITDA? EBITDA per metric ton means how much you are earning on a unit. It means it basically is a unit economics. So they were earning 400 to 1100 on the on per metric ton they sold. He said now he has taken some assumptions to project the earnings of the Unitech Ultratech. Sorry, he said that assuming a capacity utilization of 90% for 3 years, and despite an price hike of 10 to 12%, the Ultratech should be little more than 2 times. On that assumption, basis of that assumption, today's stock price, the company would be valued at 20 times P and 12 times EV by EBITDA. Now, what do you mean by EV by EBITDA? EV by EBITDA means the enterprise value divided by EBITDA. How much you are earning on a unit? It means it basically is a unit economics. So they were earning 400 to 1100 on the on per metric ton they sold. He said now he has taken some assumptions to project the earnings of the Unitech Ultratech. Sorry, he said that assuming a capacity utilization of 90% for 3 years, and despite an price hike of 10 to 12%, the Ultratech should be little more than 2 times. On that assumption, basis of that assumption, today's stock price, the company would be valued at 20 times P and 12 times EV by EBITDA. Now, what do you mean by EV by EBITDA? EV by EBITDA means the enterprise value divided by EBITDA. Now, enterprise would value at 5 times price to book value. Price to book value means how much of a value you are paying for 1 rupee of asset for that company. He said that it is very hard to comprehend the commodity business at such a valuation, because this valuation were merely because of the optimism in the market. He says that there is another valuation metric called as EV by metric ton. EV per metric ton, on that value, that company it is value what it value was 600 crore per million metric ton, which is almost thrice the replacement cost. The replacement cost means the if the all the assets of the company were sold, then what would be the value of the company? He speaks about the challenge of capital valuation 1600 crore based on peak EBITDA of 150 crores. He said that EBITDA to per metric ton ratio of 1500 suggests that it is merely driven by the optimism in the market, and people are expecting that the previous upswing would be repeated. And however, he believes that it is not likely to be going to be the case, and he says that the previous situation was just like a blessing. It put everyone off guard, and it is not likely to be repeated again. He said that there are only two present consumer present in the market for cement, is that are housing and infrastructure. But the problem here is that there has already been much more development in both these sectors, so there will be only selling of inventory and power and maximizing capacity of power plant, but this does not give rise to new demand. Of course, now you might argue that hey, government is also trying to increase the infrastructure and spending more and more, but that would only lead to increase in the demand to up to a certain extent. But the type of extent which we are expecting due to the previous upswing is unlikely to be repeated this time. So now next topics will be explained by my batchmate Shrod Gupta.
So let's move further. So here the interview asks Sir about the use of leverage. So Sir says that it is important that you give time to your investments and generate returns rather than using leverage. Sir says that he does not like to use leverage for his investment. The next question is the use of future and option. So says that he has generated extra income. He has generated extra income in futures and option, but Sir himself is agreeing to the fact that he does not understand the technicalities of the futures and option market. So he does not like to do much of it. The next of it is when the interview asked Sir about does he short in the market. So Sir had shorted a stock in the market, but had a very did not have a fruitful experience in the market. So sir does not do it further in the market, and he's also explained what are the limitations of shorting in equity markets. Let's move further. So the interview asked sir about how has the investing landscape changed in India since you started investing. So sir had a very optimistic view for the equity markets in India. Sir had put out some important points like the settlements are shorter in the market, which is the T+1 settlement which has recently come. The regulation is tighter, transparency has improved, interest rates are lower, liquidity is high, and the foreign institutional investor, that is the FII, has increased in the equity market, leading to an efficient market. Sir has also said that the valuations of the company have also grown significantly, mainly in the private markets. And one of the things, few things that Sir has seen no change since he has started investing are a lack of administrative reforms, populist policies, and unscrupulous promoters. But he says that gradually there could be positive changes in the equity market. There could be positive changes in the equity market. So here the interviewer has asked Sir about how has his investment style changed if you think it's a bull market or a bear market. So Sir says that it is important to identify the cycles of bull market or a bear market, because in bull market the companies are expensive, and in bear market the companies are relatively cheaper, and in bull market you need extra cash to buy companies. And also he says that the timing the market and the shift timing the shift precisely is a very difficult is a very difficult game. And he also says that if there is any government reforms happening or any government policy changes, he does not changes his style of investing. When the interview asked her about the experience of two major bubbles, that is the 2000 and 2007 and 2008, he says that there were similarities in both these bubbles. The similarities were fueled by manias, saw liquidity driving stock prices extremely at high levels, and disregard quality and negative news. After the bubble burst, he said that it took 5 years for his investment to cope up from that loss. And he says that the difference in both these bubbles were the first bubble recovered quickly while the second bubble took time, and in the second bubble the valuations were relatively very high than the first bubble. He emphasizes that it is important to be patient and continue your investing through these processes, so in further years after the bubble you would generate returns. So let's move to the next question. So your sir talks about the macros of the approach on macros. So he says that he does not he disagrees with the Philip Fisher's perspective of investing. He says that it is important to know various factors such as investing companies, consumer behavior, government policies, competitor moves, technological changes, and global stock market, because these important factors are interconnected some way or the other. And he says that uh, the global macros has gained importance or in the recent years. And he also sees he mentions a point that the macro factors, that is opening of the economy in India and global macros, has gained more importance. In India's case, it is important. The important macro factor was opening up of the economy and increasing foreign institutional GDP growth rate. Growth has an impact on equity markets. So highlights on the points of financial disruption enabling a development in the economy. He says that financial innovation have detached from economic values, leading to crisis of rich becoming more richer and common man being taking common man at stake. He also highlights a point of holding cash as risk mitigation strategy. Like if you hold cash, you wouldn't make loss at that time. He says one could minimize the risk by being patient and generate returns as their investments grow. He puts a point that he finds private lending the riskiest and capital market being the safest asset class. He emphasizes that private equity is riskiest because of stringent condition of lending, including collateral, personal guarantees, and conversion agreements. He says that it is important to observe the cash flow in private equity segment. Some few factors, some factors to view a stock is looking for a track record of the business and having a visibility of 3 to 4 years of further earnings that could double the earnings of the company. He is also comfortable paying 7 to 8 times current year's earnings for such opportunities. The third last point he mentioned is he finds private equity investing quite challenging because there's the cost for exits in these businesses. So he says that here they see promoters track record and ensure proper financial accountancy is proper. So let's go on to the next slide. So highlights about the personal life. He says that he says that equity investing is difficult. So one could opt for index investing because it is fairly easy, and so has talked about the four investment classes that he does it in. So it is public equity, private equity, buyouts, and structured debts. He follows a day-to-day pattern of spending his time on tax planning, monitoring existing investments, researching new opportunities, staying up to date on policy, on macro changes, networking, and reading. So he, in his flexible schedule, he also likes to do traveling, listen music, exercise, reading, and playing chess. So let's go on to the new stuff to new investors. So says that it is important to do research and invest in right place and cut your losses if you find your investments have gone wrong, and have a discipline about investing and don't follow the herd. Where the herd is investing, you should go and invest there. The second point is he says that one should be disciplined about the prices, the assessments, and the asset allocation that one does, and it is important to do the homework in order to earn returns and uh, in order to earn returns in the capital market. The third point is, so advices is to start as a new investor to start in a bull market and invest in mainly large cap companies, because it is very difficult to go wrong in the large cap companies. And if a person does not have the time to do research, so it is important that he does a SIP on a regular basis in a disciplined manner. So this is where we conclude the learnings of two investors. Please note that we are not giving guidance about the investments. We have just tried to explain the learnings we learned through these two investors.